Hello and welcome to our new section, which is ratio analysis. In the previous two sections, we learned about the balance sheet, we learned about the profit and loss, and we learned about the details and the meanings of those things, and then we learned also about the trend analysis in P&L. In this section, and we have been talking about a lot of about the ratio analysis, and the ratio analysis is important to compare between different companies, compare trend from one year to another year, and then see what are the trends and what are the results. And also, the ratio analysis serve a lot of ratios serves as a KPI for in many companies. So let's look at what are the ratio. So we are not looking. There are a lot of ratios in the balance sheet and financial statements, but we are not going to look at all of them. We are going to look at only a couple of them, which are very important and in generally used. So first, a few of them are like in this slide. We will be learning only about the names and the general numbers, and then after that we will be actually going over the Excel worksheet or our balance sheet in the test case, and then we will be doing some calculations. Now, current ratio and asset ratio means these are the current asset versus current liabilities. So we are trying to know if our current assets are our assets. Current assets means debtors, inventories, or other advances, deposits are enough to pay off our liabilities, which are current liabilities, other suppliers and other things. Asset test ratio means a lot of current assets are not realizable in a short period of time. So asset test means that what if tomorrow or in a week or in a 2 weeks or in a month period of time we have to settle our liabilities. What is the possibility? So here we exclude a couple of things which are not recoverable in cash. For example, inventory you can't really find out so fast. You can sell them fast. You can do with the debtors. You can add the cash, bank, treasury bills, and other convertible assets. But long-term deposits you can't include in the current ratio because they are not really, you can't really recover them in fast. Debt equity ratio, this is a capital leverage ratio. This is also called a very important ratio in when you have taken a debt. So by this ratio we try to, the companies or the users may try to understand what is the possibility, or what are the how good the company is being used, leveraged by the debt. We will be looking at a few of the details, a few practical examples to understand about it. And then average collection period. In the previous slide, previous video, we learned what if there are fake sales. There may be fake sales if average collection period is increasing. So we'll be learning about it more. Average inventory holding period is also one measure of how effectively you are using your inventories. Gross operating profit margin ratio, and then EBITDA, and what is the comparison versus gross operating margin and earning before interest, depreciation, tax and advance amortization. So that's a full detail of earnings before interest, depreciation, taxes and amortization. Earning per share, and then we will be looking at the return on equity and finally return on assets. So let's look at it now. Let's go to the practical examples of this. I have calculated it already, but we can do calculations again, or I will be showing you by traces if it opens. Yes. So now we are into our balance sheet. I have converted this balance sheet into Excel format so that we can calculate and show you the calculations easily. The first one was current ratio. So how we calculate is the formula is current assets divided by current liabilities. So here in this case you can see that I'm showing you the where did I get this figure. So this figure we got it from here, current assets, and then this figure we got from current liabilities, so which one you can see here. So the ratio is 0.65. So means it does means that the company has very low current assets. If tomorrow there is something going wrong, some happenings are there, the liquidity of company is pretty is considered as low. The reason being, a lot of investments are put in company into the long term investments, not in short term investments. That's the reason why the short term liquidity is a bit weaker. In real world, in generally is a ratio of 2:1 is considered good, up to 2:1. More than 2:1 is also not good, because then you are not leveraging the possible working capital cycle. You are not taking enough credits from the upwell, but you are giving a lot of credits. Now, asset test ratio means the current assets minus inventory and other current assets which you cannot readily convert into the fixed so here into cash. So here this minus current assets minus the inventory. So the investments, short-term investments, receivables, cash, small loans, small financial assets. Now we saw earlier that some of the current other financial assets may have include deposits. So in practical terms, we should actually remove those, but for the sake of simplicity, we are not removing it. The current liabilities remain the same. So here the asset test ratio is 0.39, which is pretty low compared to the industries. I don't have the industry average here, but we can consider look at the other petrochemical companies. If their ratios are similar, if yes, then it's no problem, but if no, then there is an issue. After a while, we will be also looking maybe in the next video, we will be looking at the ratio comparison between two different companies into probably the same sector. Now let's look at the next here, average collection period. Now average collection period is this is actually calculated into two different steps. One is the average daily sales, which is 365 3 total sales divided by 365, and then you can calculate that every daily sales from average debtors. So which will be lead you to the formula is like this. So just remove the arrows first, and then we look at the arrow again here. So this one divide by multiply by 365 divide by total sales. Now here we has another catch, because most of since the debtor receivable are very low and the sales is pretty high, it must be that there may be not a lot of sales are on credit. Maybe it's most of the sales are on cash. So here from the face of financial statements, we don't know how much is the credit sales in here and how much is cash sales. So for the sake of simplicity, I am calculating based on the total sales. However, in reality, you should calculate it based on the credit sales only. Then only we will be able to get the real average collection period. Here it shows average collection period is 12, which is pretty low. It must be because of the sales. We don't have the credit sales available in this company in this case. But let's say, what if it was half of it? Let's say half of the sales was. So what we can do is we can go into the formula and we can change it. So how we are dividing it is divide by 2. So you will see the average collection period increased to 25 from 12. So which means that in this case, the company is able to collect its dues within 25 days, which is pretty fast. Now average inventory holding period is also calculated in a similar way. Average daily sales, average cost of sales daily divide by and this divided by average inventory. Now here is the 66 days, which is actually pretty high. because it means you are holding your inventory up to 66 days before it gets sold. So it means that you are holding your inventory very high before it gets sold. It's a matter of, we cannot compare it from one company only. We need to see the industry standard and comparing with the year on year basis. So you can actually just copy the formula and put it here. So here previous year it was 66.19, now is 66.44, which is pretty okay in terms of year on year. However, here you can say that the increase in the debtors is increased from 15 to 25. If you remember, in the previous video we were talking about, if the average collection days are increasing, the sales might have been booked wrongly. But considering the percentage to the total sales is only 5,000, 4,000, 5,000 to 10,000, while the sales are 300 over 1,000. So there is no way that the company will be doing a misrepresentation by adding only 5,000. So it might be a difference in this month. Something might have been different, or the companies are not paying them sufficiently, which we have to go into details if we have access to the financial statements, financial records. So these are the three utilization and current ratios. Now we go into the debtor liability side part. So liability side part, we have a few ratios where we see debt equity ratio. So in this particular percentage, the debt is about 26% of equity. Here also we calculate debt divided by equity, which is pretty low. It means that the company is not leveraging the debt into the full. If the reason, probably it might be because it's cash rich. It has a lot of cash pile. They are making a lot of investments into the different companies. That's why instead of taking loan and utilizing it to invest in other businesses, there's no point in taking loan. So but if let's say you are cash, you don't have enough cash of your own, don't have a lot of investments, the profitability can be higher for equity holders if there is a cheaper debt available. So in that case, capital leverage can be better. Now this kind of decisions on the capital leverage we will discuss in capital budgeting in our other courses, but for this point of time we just say this is the debt equity ratio. Now there is a return on equity ratio. Return on equity, which means that how much is the net profit divided by equity, so which is about 10%. It's not a lot. It's compared to the last year. Last year you cannot compare because I am missing the formula. Okay, this ratio is also we need to see compared with the other companies. Here the equity, because there is a lot of investments, all the money is not invested into the operations directly. That's why that may be one of the reason why the return on equity can be affected. Again, we have to compare with other industries, comparing with the similar size companies to know more about it. So this was the most of the okay, so the rest of the ratio we will be learning in the second part of the video. Thank you.